Early in the game, Icahn seems to be singing the familiar company as a takeover target song he has played with past investments, most recently at Motorola Mobility. While it's worked in some scenarios, there are some on Wall Street who believe it won't work here, even among the bears who have long considered Netflix and FLX plus 1.74% apiece of Silicon Valley's overvalued hype machine. Netflix's board and chief executive Reed Hastings are not taking any chances. On Monday, the DVD and streaming company adopted a poison pill plan, the signal that they are digging in to keep Netflix intact. Read, Netflix adopts poison pill plan to thwart Icahn. Last week, Icahn announced via a regulatory filing that Icahn Capital had accumulated a 10% stake in Netflix, and investors jumped to speculate about merger candidates. Icahn pointed in that direction, saying in interviews that the industry was consolidating and that Netflix should be consolidated. Coming on the heels of rumors that software giant Microsoft Corporation, MSFD plus 0.44% was looking at Netflix, its seemingly downtrodden stock spiked. In the short trading week, Netflix soared 15%. Read, Icahn sees Netflix as a Halloween treat. The problem is that, even with the legendary stumble by the company last summer that erased more than 2/3 of its market value, Netflix is not cheap by any measure. The stock trades at more than 175 times its estimated earnings for fiscal 2013. According to FactSet data, it trades at more than 44 times cash flow, more than double its 5-year average. Pushing for a takeover of Netflix might not get very far, as many on Wall Street are already flummoxed about possible combinations. Representatives at Icahn Enterprises in New York did not return a call seeking comment. The knee-jerk reaction here by sell-side analysts is to upgrade the stock, said David Miller, an analyst at Caris & Co. When you say, who is going to buy them? You get a blank stare. It's fine to sit there and hope for a sale, but if there isn't a buyer it's a waste of time. Miller added that the only possible acquirer in his mind is Amazon.com Incorporated, AMZN plus 0.82%, but he noted that if there is only one buyer, why would they pay a premium? Michael Pachter of Wedbush has long and very shown Netflix, and in a note called his current $45 price target on the stock charitable. That represents a 20 times earnings multiple to its U.S. streaming business, and a $10 option value to its money-losing international business. We do not believe that a prudent acquirer would pay more than this, and think that the underlying rationale for Mr. Icahns' investment is unfounded, the analyst said last week. Carlos Kurgiander of Bernstein Research wrote Monday that we do not believe one can make the case that Netflix would be better off with a different leadership team or strategy, which calls into question the rationale for activist involvement. Another factor to throw in the mix is Icahns' own record. In both technology and media stocks, his performance is seen, to put it politely, as spotty. Others are more blunt, at least on the media side. Icahns' activist track record in media is pretty bad, Miller of Caris & Company commented. There have been all kinds of failed attempts at change and subsequent value destruction. Some of Icahns' media stock investments included Yahoo Incorporated, YHOO plus 1.51%, Lionsgate Entertainment Corporation, LGF negative 3.44%, and Blockbuster, now part of Dish Network Corporation, Dish negative 1.58%. Netflix's current situation reminds some investors mostly of Blockbuster, the video rental chain, which ended up filing for bankruptcy. Both Netflix and Blockbuster were buffeted by a rapidly changing marketplace and shifts in technology at the time of Icahns' investment. In case any investors forgot, in 2005 Icahn bought a big enough stake in Blockbuster to wage a proxy fight, and he ended up on the board. He is seen by many as having interfered with Blockbuster's management. An interesting discussion followed in the Harvard Business Review after the former Blockbuster chief, John Icahn, wrote an article in April 2011 about sparring with an activist investor. Icahn, for his part, called Blockbuster his worst investment ever. Read comments on Icahn's HBR piece. He could disrupt growth if he were to challenge management strategy, as he did with Blockbuster, Tony Weibel of Janney Capital Markets wrote of Icahn in a note last week. In an email Monday, Weibel elaborated further after the poison pill news. Seems like the odds are now in favor of Icahn being more aggressive than passive. His 13D filing suggests he is not happy. Any feud could be disruptive for Netflix as it was for Blockbuster. The analyst added, however, that the new rights plan and staggered board means that Netflix can disregard his intentions. It's not a given that Icahn will pressure Netflix for a deal, but he is seen as the potential force behind Google Include.SGOG negative 0.72% acquisition of Motorola Mobility. In a regulatory filing just 1 month before Google's $12.5 billion acquisition in 2011, Icahn recommended that Motorola explore its options with its patent portfolio. Whatever happens, it looks like Icahn could be an albatross around the neck of Netflix's Hastings and his efforts to get the company profitable and growing again.